I've made a variety of wealth building and retirement scenario videos along with my monthly portfolio updates on this channel. A few of you have recently asked me how I plan to transition my portfolio closer to and in retirement. And it made me realize I've never pieced together the full picture in one clean video. I usually try to use common scenarios that apply to as many people as possible when I make videos about building wealth or planning for retirement. In this video, I'm letting everyone backstage as a VIP. We are getting as transparent as humanly possible here. I think showing my personal retirement plan will resonate with those of you out there living the family life that have different needs than someone like a single minimalist. Not that there's a right way to live your life, but I'm just saying, $1 million portfolio will only go so far in our modern world with a mortgage, multiple kids, no more pensions, questionable social security income, and rising inflation. I always say that there's no one size fits all to this money stuff, and it's never been more true than when it comes to finding our retirement number. We'll get my retirement all dialed in, and then we can laugh at me later when things don't go as planned. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please sack that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. A quick shout out to the Seeking Alpha Black Friday sale. Consider using my link in the description below if you or a friend is interested in Seeking Alpha Premium. The deals are always changing throughout the year, but right now you can save $90 on your first year, and that's good for new and returning members. You know what time it is. Let's grow. Building wealth before retirement. I love helping family and friends develop a solid plan that works for their situation. It always gets me hyped for my future, and the spreadsheet warrior in me starts cooking up elaborate retirement scenarios. But then I remember I'm still in the accumulation phase. We need to build up that portfolio before we can start the real retirement and tax planning. Since most of my videos are about smart investing to build stable wealth, I'm going to keep this section to the absolute requirements only. Now, if you go the extra mile and you track every single dollar on a detailed budget, then I consider that an extra bonus and you are well on your way. But anyone, and I do mean anyone, will build stable wealth over the long haul with these basics. Wealth building for dummies, like me. Avoid or pay down credit card debt with your highest priority. Live within your means, don't lifestyle up when you get raises, and ignore the Joneses. Contribute to your 401k at least up to the company match. Free money is good money. Invest in low-cost, passively managed ETFs or index funds in general. And dollar-cost money in all markets and ignore the ridiculous news, and don't try to time the market. And now there's obviously more things that you can do to maximize your wealth over time. Check out literally any of my videos for more information about how to build stable wealth during your working years. But we're here today for my specific retirement scenario. So let's head that direction. Finding your retirement number. I often read that us spreadsheet warriors are in for a rude awakening as the world around us changes and our projections are blown up. This was explained best by Mike Tyson when he said, "Everyone has a plan until they get punched in the face." This is one of my favorite quotes of all time, and my friends and I love throwing this one back and forth at each other. But this spreadsheet warrior makes sheets that update in real time as changes happen. Before we dive into those, we need to find our magical retirement number. This one's funny because people commonly throw out numbers like $1 million or $10 million or give me 500,000 and I'll be fine without doing any calculations. Step one in finding your number is to figure out how much money you spend on a monthly basis. And this is as easy as reviewing your checking or your credit card statements wherever you do your purchases. And remember, we'll all have different numbers. I've had multiple people on the channel tell me, dude, just retire now. You could produce $60,000 a year easily of passive income with your current portfolio. Now, this would be more than enough for single teeps. Believe it or not, I'm a low-key minimalist at heart. But with life now, it literally wouldn't cover my mortgage, family health insurance, and other fixed costs in life. And this is even if I'm the most frugal minimalist in world history. It's just impossible at this point. So just keep this in mind. Never judge people if their number is a lot higher or a lot lower than yours. We all have different situations. Now, my personal number that I would be willing to fully retire on happens to be around or just over $3 million. And we'll break it all down in the spreadsheets. You know me, I'll definitely get there. But I'll tell you, I don't use the traditional wisdom of taking your yearly expenses multiplied by 25. That basically equates to a 4% yield, because we all have different portfolio compositions that we're comfortable with. Now, before breaking down the specific retirement math, let me show you where I'm at in the journey as is and where we need to get to. We're gonna hop out to the projections tab on my most recent weekly portfolio update. And this tab here just shows my monthly contributions, and it breaks it down over here. Basically, it's a 401k and a huge 401k match and an HSA. I do contribute to M1 Finance from my YouTube money, but I put $100 a week into M1 Finance. I count it as zero because I like to be conservative with this. So I actually invest more than this, but I like to dumb down the numbers a little. My wife and I currently have about $1.5 million. This just sums everything up from all the tabs from the inputs. For date of birth, I just put today. You can put date of birth and this will show your age. But since we're talking about when I'm going to retire, we want to know how many years we have left. And then for the growth percentage, and this does not include inflation. So really this is like 5 or 6% if you want a real return. I do inflation on the next spreadsheet we'll go to. So this is just the raw return, the nominal return. The market's average 10% over the last 100 years. My portfolio has been 14 to 16%, but it's been a good run. I like to conservatively assume that I'll perform worse in the years ahead. So this is an 8% return. Again, not factoring in for inflation yet. Pretty conservative numbers here. And you can see in 3 years, we're expected to hit 2.1 million. And then I'll reshape the portfolio allocations a decent amount. And then hopefully in 7 years, it hits that magical $3 million. And this is when I feel I'll be ready for the next step. Maybe 3.1, 3.2, we'll see, somewhere in here. This could end up taking 15 years because we could have a lost decade. Or I could get there in 5 years if I continue to return like I have historically between all my investments. I could get there in 4 years. So 7 is just an estimate. This thing will update real time as our investment value changes each week. And so it'll push it out properly. So this is just an estimate, but for this video, we're going to assume that we make it on the base case here in 7 years. I must admit, and this is entirely by chance, but my number does happen to be right around 25 times my yearly expenses. So maybe they're onto something with that one. Cash flow versus the 4% rule. I want to make it clear why my retirement portfolio that we're about to check out isn't necessarily the best move for everyone. I prefer a portfolio that pays all of my bills with passive income. I don't want to have to sell any positions to produce that cash flow. But using the 4% rule with something like VTIs you're holding has a higher chance of increasing your net worth over the long haul compared to living on strictly dividends. I've Monte Carlo'd these things to death. My setup has a higher chance of lasting indefinitely by far. But my ceiling is objectively lower if the goal is to produce the most net worth in the most scenarios. It's simply not my goal. When the market drops, my method gets more powerful. It enhances future cash flow as the dividends are partially reinvested and accumulating more shares per dollar. Whereas the market dropping for a retiree living on a low-cost index fund and the 4% rule can get really ugly real quick, especially if it's in the earlier years, because you're having to sell low to produce the cash flow now to pay the bills. For example, let's say you had $1.5 million of VTI, and then the market does the next big crash and you're all the way down to $1 million. You'll still need to withdraw the same, let's call it $75,000 to live that year. It proportionally takes a larger chunk of your portfolio to live the same lifestyle. Let's see what the right way, I'm just kidding, looks like in the next section. Cash flow and Roth Conversion Ladders. My wife and I plan to retire when our portfolio is just over $3 million. The problem here is that about $2 million of that $3 million will be stuck in a traditional IRA. This is where my 401ks have been rolled into, and eventually where my wife's 401k will be rolled into. We still owe taxes on all those dollars, and we're not supposed to make withdrawals until we're at least 59 and a half years old. Now, with our base case that we discussed earlier on the accumulation phase spreadsheet, I'll be something like 49 years old and my wife will be 44. And worst of all, I haven't even got there yet, in our early 70s, we will be forced to withdraw the compounding wealth because of RMDs, required minimum distributions. And this, my friends, is where Roth conversions come into play, and more specifically, creating a Roth Conversion Ladder. You are able to convert any amount of traditional IRA dollars over to Roth dollars whenever you want. There are no age restrictions and no amount restrictions. It's known as Roth conversions. Even better, you have full access to the converted amount 5 years after the conversion is made, regardless of your age. And this works the same way as the typical 5-year rule with your normal Roth IRA, in that you can only withdraw the contributions, or in this case, the conversions. You cannot take out the earnings on the investments within the Roth. A Roth conversion ladder is a great way to minimize your tax bill over the years if you do it right, and to have money to live on real time once you're 5 years into the process. For example, let's say you have a big amount of money in your traditional IRA and you and your spouse, whatever your situation is, retire, so you no longer have income. You can convert, let's call it $100,000 per year. So each year you're going to convert $100,000 from your traditional IRA over to your Roth IRA. And the nice thing about this, on year 6 of doing this, $100,000 per year, you'll have access to that $100,000 that you converted on year 1. It's been 5 years now. And then on year 7, you'll have access to the conversion amount from year 2, 8, 3, and so on and so forth. There is a 5-year lag of being able to use the money from the time that you start this process. The taxes are owed on the conversions that you make in the year that you do them, and they count as ordinary income. So it's as if you made more money from your regular job. We'll want to go about this in a smart way to reduce our tax bill as much as possible and to avoid RMDs altogether. It's finally time. I'll get into that and everything else we've talked about now. I made a copy of the dividend projector spreadsheet that I have out there, and some of the members and non-members, because it's free for everyone, probably recognize this sheet in general. I use it to track my dividends and project future dividends. But I added some stuff in this one, and we'll cover everything here. But I plugged in some retirement projections, and we're gonna hide this to clean this up a little. Let me see. Okay, good, everything's on one screen. So let's do this one step at a time. I'm going to start with my yearly need in 2024 in my current lifestyle. It's about $120,000 per year. Now, don't forget that we're not retiring in 2024. We're looking more like 2031. And give or take some, like we talked about earlier, but base case 2031. So adding 3%, I might have used just under 3% because I round everything, but 7 years of inflation, I'll need about $147,000 to break even ultimately and cover my costs. And then I just, out of preference, put a $20,000 buffer in there. I want at least $20,000 more to have a little extra fun. So when you add together the $147,000 per year plus a $20,000 buffer, I'd like to produce $167,000 per year. And now if you look at the comp up here, and we'll get there, it's producing $192,000. That gives us a reinvest buffer on top of the 20K fund buffer of $25,000. And something to keep in mind, when you retire, your living costs commonly will naturally decrease. I'm just conservatively not factoring that into this figure. It's pretty common though to have your spending slowly go down. I mean, there's always gonna be inflation, but just as far as the real dollars. So I plan to reinvest the 25 or so thousand into SCHD, JEPQ, and then probably some, VU or VT or the HODL factory, my individual stocks as well. They won't technically be zero. I just want to show an example portfolio of day one getting by, and then you can put the excess into whatever you want. Now, back to that problem. Of this 3 million, about, and this is projections, based on the current growth estimates, about $1 million or so will be in a taxable account. Right now, it's just over $500,000. So that would be 100% SCHD, of course, to keep 100% qualified dividends. And then the other, call it 2 million, is $500,000 of SCHD in the traditional IRA that were rolled over from all of our 401ks, and the whole $1.5 million in the traditional IRA. So at this point, year one in 2031, we don't have any money in a Roth. And in reality, we have a little bit. Let's just say we have zero in a Roth of this $3 million. We gotta talk about conversions. And I should have stated coming into this trailing 12-month dividends are what's actually happened for these funds lately. So it produces these yields ultimately based on the current price that the spreadsheet's pulling in. And these dividend CAGRs, I just assume 0 for JEPQ. Technically, it'll be around 1%. The premium income from the options will go up and down based on the volatility, but the underlying holdings do pay a little bit of qualified dividends that have grown at over 10% per year historically with QQQ as our barometer for that. But I like to conservatively say 0. And then for SCHD, I have the lowest of the 3, 5, and 10-year dividend CAGR. The 5 and 10-year are actually 12 and 11. So this 3-year is 9.5, and that's the one I went with. But you can plug in whatever numbers you want for this. Yearly inflation, it's usually 2.5, I assume 3%. As you've noticed the trend for me, I like to put everything a little against myself from the historical norms. And you can see with a weighted yield of 6.43% and a weighted dividend CAGR, dividend growth rate, so you compare this to inflation of 4.75. This makeup here does increase your purchasing power per year. So in year one, of course, your purchasing power is the actual dollars. And then as we make more money here, this is the estimated dividend income per year. And keep in mind, this was without reinvesting a penny. This is just with these shares. So reality is going to be a lot more favorable. Again, I like to keep it conservative, but without reinvesting, you can see that your nominal dollars are going up a lot, but your real purchasing power is also increasing. So in 2040, 9 years into retirement or so, you'll have $222,000 of 2031 equivalent dollars. So your lifestyle's only getting better as well, even before reinvestment. So I like this setup to start. And then, like I said, I'd put this reinvestment into the VTs and the VOOs and holdings like that, just to build some stable wealth in addition to the cash flow. Come this time, I'm 49 and my wife is 44 years old. We can't touch those traditional IRA dollars. That's where the conversion comes in. Now remember, our taxable account has about $1 million of SCHD and probably realistically a couple $100,000 of money market, to be honest. And we need that because we're going to do a yearly Roth conversion. I don't know why I have that number in there right now. Let's just say $200,000 per year. And I made this little calculator here. So remember, we'll have 0 income at this point when we are both fully retired. And if I have YouTube money at that point, I just consider it a bonus and it's all in 22%. That's all good. But starting at 0 income, if we convert $200,000 per year from our traditional IRA to our Roth IRA, we'll pay taxes of 0% on the first 30K. That's that standard deduction. And then the 10% gets $23,000 taxable. The 15% has the next $73,000 taxable, and the 25% has a 73. Again, in reality, right now, this is 12% and 22%, but I always like to stack these things against me. That's just how I'm wired. So in theory, if the taxes were this and we converted $200,000 in 2024 thresholds, so really we'll get more money in each of these because they'll increase with inflation, but not even giving ourselves that benefit of the doubt, we would pay $31,000 of taxes in the year that we make the conversion. So remember, the portfolio is still producing $192,000. You can do an in-kind transfer of, say JEPQ from your traditional to your Roth, 200,000 of it. So you still get the 192, but on the side from your taxable, we're paying 31,000 out of pocket, which is just fine when we have $1 million of SCHD and we have a couple $100,000 money market. So you pay those taxes in the year that it happens and you get that $200,000 working for you in the Roth. And then the next year, we would do that same thing. We would convert 200,000. And if it continues to grow, we might say, yeah, we have to convert 250,000. Or if we have a major downturn, shoot, I might get away with just converting 150,000. That puts a lot less in the higher tax bracket. You could see it's a big difference. 150K only costs you 19,000 in taxes. in 2024 thresholds, whereas 200,000's up over 30. So we'll kind of play with this as time goes to ultimately drain the traditional IRA to zero before the age of 72. I hope to get it there by 65 or so. So don't forget about that $31,000 taxes. Now remember though, in year 6, so we've paid 30,000 times 150,000 or so. But in year 6, when we do the conversion and cover the taxes and continue to reinvest everything so we have plenty more coming in than what's going out, we don't need it yet, but we have access to 200,000 of the Roth. And then in year 7, we'll do the same thing. We'll pay our taxes. And again, these thresholds will go up. So if we did 200,000 every year, we wouldn't owe as much in taxes in each future year because we'll get more dollars hidden in these. Once you get to the point where you can cover taxes from your conversions, again, out of your taxable account, you have to have access before 59.5, that's the taxable. To start the ladder, you're good to go. And what I would do is I would let my taxable account dwindle away. So if I'm in year 8 and I do another conversion and we're paying bills and living out of the taxable account, we might see it go down 147 plus some inflation plus this tax amount. So our taxable is going to eventually, even with the growth, get down to 800,000 and then 600,000, 400,000. I would let it dwindle down to a couple 100,000 before I touch the Roth, even though at that point, say we're in year 9, year 10, year 11 of the conversion ladder, I would have access to over $1 million in the Roth, but I still wouldn't touch it. I just let it compound. And then when I got down to 100,000, 150,000 in the taxable, I might start trickling out my Roth and should be good to go for years to come. And remember, with our taxable income, after all the conversions are done, our taxable income will be $0 and 0 cents on a yearly basis, assuming no extra money outside the portfolio. And that's qualified dividends on SCHD. You get in 2024, you can have up to 126,000. They won't reach that, but even if they do, they'll be tax-free. And the JEPQ income at that point and other things, because I'll slowly convert it to VT and things like that, will all be in the Roth. So it'll be tax-free for life. I plan to release a couple more detailed videos that will cover Roth conversions and Roth conversion ladders and something else known as a 72T. This one had way too much to cover, unless you wanted me to go for over an hour, and I'm guessing the answer to that is probably no. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated, freedom is not. Thanks for watching, and I will see you in the next one. Peace.